Imagine waking up to rising prices, but the job market is weakening at the same time. Your grocery bill climbs, your rent climbs, and yet finding stable work becomes harder. What happens when inflation refuses to fall and economic growth slows, and unemployment starts rising? You get one of the most troubling economic conditions, stagflation. And if you've been hearing that word more often lately, it's for a reason. Stagflation is what happens when three things collide: slow or negative economic growth, rising unemployment, and high and persistent inflation. Individually, each one is a headache. Together, they create one of the hardest problems a modern economy can face. Why? Because the solution to one problem usually makes the other one worse. If the government lowers interest rates to help workers find jobs, prices rise even faster. If the central bank raises interest rates to slow inflation, businesses pull back, unemployment rises, and growth stalls. Stagflation is a tug-of-war where every move hurts someone. To understand the challenge, think of the economy as a car. Inflation is the engine overheating, unemployment is the wheels slowing down, and growth is the speedometer falling toward zero. Typically, fixing the overheating engine means slowing the car down, and fixing the speed means giving the car more fuel, but that overheats the engine again. It's a delicate, messy balancing act. Now, why is stagflation suddenly such a big concern today? Let's break down the forces behind it. Recent revisions have shown that earlier job reports overestimated employment by almost 1 million jobs. This means the economy may have been weaker than it looked. Add to that falling labor force participation, underemployment, rise in gig and unstable work, and households doing only a few hours a week but technically employed. Are we underestimating how many people are struggling? Are we masking weaknesses beneath the surface? These are the questions economists are now seriously asking. Official inflation numbers look better than they did at the peak of the pandemic. But real-life inflation, the kind households feel, tells a different story. Think about shrinkflation, higher housing costs, higher food prices, and services that cost more but provide less. Even if inflation slows today, it doesn't erase the painful years when inflation sprinted ahead. Prices don't fall back down. They just rise more slowly. So households still feel squeezed. Much of recent GDP growth has been driven by government spending, AI-related investments, and consumption from high-income households. But what happens if those few pillars wobble? Is the economy balanced or standing on stilts? The US and many other countries face rising debt, lower tax revenue, higher interest payments, geopolitical uncertainty, and declining global demand for US bonds. If interest payments explode, governments may be forced to choose between raising taxes, cutting spending, or letting inflation quietly erode the value of debt. Each choice has consequences. Stagflation gets worse when the central bank is trying to cool inflation, while the government is injecting massive spending. Trade policies strain supply chains, tariffs raise prices, and tax cuts fuel demand for luxury goods. It's like one hand trying to slow the economy while the other slams its foot on the gas. Let's look at what it actually means for various aspects of the economy. Stagflation hits everyday people directly and usually painfully. Household budgets stretch further. Groceries, rent, utilities, and everything cost more. Savings lose value. Money sitting in an account buys less each month. Job security falls. Companies freeze hiring or cut hours. Debt becomes more expensive. Higher interest rates hit mortgages, car loans, and credit cards. Financial stress rises. More families live paycheck to paycheck. What do households do when both their expenses rise and their income becomes uncertain? For many, the answer is they cut spending, and that weakens the economy even further. Businesses face the perfect storm: higher operating costs and lower consumer spending, tougher access to financing. Borrowing becomes expensive, layoffs and hiring freezes. To survive, companies cut back. Pricing dilemmas: raise prices and lose customers, or keep prices low and lose profit. How do businesses grow when the cost of doing business rises, but customers have less to spend? Many don't. Some consolidate. Some shut down. Economies stuck in stagflation often experience slower innovation and higher national debt burdens. Weaker consumer confidence. People delay big purchases. Tighter financial conditions. Banks become cautious. Political tension. Economic hardship often fuels social and political division. Stagflation doesn't just damage the economy, it strains the social fabric. But there's no magic button to solve the problem. Solutions typically include very careful interest rate adjustments and long-term fiscal discipline. Supply chain improvements, policies that support productivity, responsible government spending, targeted tax reforms, reducing barriers to business investment, and encouraging labor force participation are also key. But these come with trade-offs and often require short-term pain for long-term health, which raises another key question. Are societies willing to accept short-term sacrifice to avoid long-term crisis? Stagflation is not just an economic concept. It is something that affects your paycheck, your grocery bill, your job prospects, your savings, your long-term goals, and your everyday quality of life. That's why we need to understand it, not fear it, but stay informed and prepared. Economies have survived stagflation before. It requires smart policy, patience, and awareness. And awareness starts with conversations like this. If this breakdown helped you understand the economy more clearly, hit the like button, subscribe to the channel, and share this video with a friend who needs to hear it.